If your car payment is $499 a month, you probably think, cool, I can afford this. But here's the problem. The monthly payment is the last number you should trust, because a payment is the easiest thing to manipulate. A dealer can make almost any car fit your budget by changing just two levers, APR and loan term. Stretch it to 72 or 84 months, bump the rate a little, roll in a few fees, and that $499 still shows up like magic. And that's the illusion, that $499 isn't proof you can afford the car. It's proof the deal was built to look affordable. Because APR and term decide whether $499 is a plan or a payment trap that drains your income every month. Here's what I mean. On one side, you see $499 per month. But on the other side, you're quietly paying an extra $7,200 in interest, money that could have gone to your emergency fund, debt, or investing. So in the next 15 minutes, I'm going to show you how this trap is built, how to spot it instantly, and the numbers you must check before you sign anything. Most people think buying a car is about negotiating the price. But in the real world, the game is usually played around one question at the desk. What monthly payment are you trying to be at? And the moment you answer that, you've basically handed them the steering wheel. Because the payment trap is when you focus on the monthly payment instead of the total cost of the deal. Dealers love the payment trap for one reason. They can make almost any deal fit your budget on paper without actually making it cheaper. Here's how. They take your target payment and they build the deal backwards. They stretch the loan term to 72 or 84 months. They adjust the APR, and they roll extras into the financing, warranties, protection packages, fees, so you're not just buying a car, you're borrowing more money. And since most people never ask for the total cost, they walk out thinking they got a win. But what they really got is a loan that looks affordable today, while it quietly gets more expensive every month you keep paying. That's the enemy in this video, not the car price. The payment trap. All right, now let's talk about APR without the confusing finance language. APR stands for annual percentage rate. It's the cost of borrowing money expressed as a yearly percentage. And a lot of people hear a number like 6%, 8%, 10% and think, okay, that doesn't sound too bad. But here's the reality. On a car loan, APR isn't just a small percentage. It becomes real dollars, often thousands of dollars, because you're borrowing a big amount of money for years. So even if the rate only changes a little, the total cost can change a lot. And here's the part that messes people up. You don't feel APR when you're staring at the monthly payment. You feel APR when you look at the total you pay over the life of the loan. That's why two deals can look the same at first. Two loans can have a similar payment, but one has a higher APR, a longer term, or more money financed. So the total cost is way higher. That's why the payment trap works. It hides the real price in plain sight. So when you see APR, don't translate it as a small percent. Translate it like this. How many extra dollars is this loan pulling out of my paycheck over the next few years? Because small percent turns into big money over time. Here's the part that most people never get shown, and it's the reason car loans keep so many people stuck. In the early months of a car loan, most of your payment goes to interest, not the car. Even though you're sending in the same payment every month, the loan is structured so the bank gets paid first. That's called amortization. And the effect is brutal. At the beginning, your payment is mostly interest, and only a small slice actually reduces what you owe. So you build equity slowly. But the car? The car is doing the opposite. Cars depreciate fast, especially in the first couple years. So while your loan balance is barely dropping, the value of the car is dropping quickly. That's how people end up underwater without even realizing it. You think, I've been paying for 6 months, I must be making progress. But when you check the payoff amount, it barely moved. So here's the punchline. You're paying the bank first, while the car loses value. And once you understand that, you stop judging a deal by the payment. You start judging it by how much of that payment is actually buying you freedom versus how much is just feeding interest. Now let's talk about the easiest trick in the book, the one that makes a bad deal look good: stretching the loan term. When someone says, I need the payment lower. The fastest way to do that isn't lowering the car price. It's taking the same loan and spreading it out over 72, even 84 months. And yes, on paper, it feels like a win. The payment drops. You feel relieved. You think you just made the car affordable. But here's what actually happened. A longer term doesn't make the car cheaper. It just gives interest more time to charge you rent. So over those extra months and years, you pay more total interest, even if the APR stays the same. Same car price. Same APR. Just changing the term can add thousands of dollars to the total cost. And there's another problem nobody talks about. Most people don't keep a car for 7 years. They trade in after 3 to 5. So with a long-term loan, you can still be paying off the old car when you're ready for the next one. That's how the cycle starts. Longer term, slower payoff, higher interest, and higher risk of being underwater. So remember this. Longer term equals more total interest and more risk. A lower payment isn't always a better deal. Sometimes it's just a smoother way to drain your income. People hear 6% versus 9% and they shrug, like it's only 3 points. But 3 points on a car loan is not a vibe, it's math. Let's do a quick real-world example. Say you finance $35,000 for 72 months. At 6% APR, the payment is about $580 a month. Over 6 years, you pay roughly $6,764 in interest. Now, take that same exact loan, same price, same term, just 9% APR. Your payment jumps to about $631 a month, and your total interest becomes roughly $10,424. That's about $3,660 more for the same car. And notice what makes this dangerous. The payment difference is only about $50 a month. Most people barely notice $50 when they're stressed at the dealership. They'll rationalize it. It's just dinner twice. But over time, that $50 becomes thousands. And that's money that could have built an emergency fund, paid down credit cards, or gone into investing. Stuff that actually improves your life. So when you hear it's just a few percent, don't translate it as a rate. Translate it like this. That's not a rate. That's a lifestyle tax. Now let's talk about a trap most people don't even know exists. You walk into the dealership thinking the interest rate is just the interest rate, but sometimes it's not. Here's how it works. When you apply for financing, the lender may approve you at a certain rate. That's called the buy rate, the rate the lender is willing to give you. But the dealer can sometimes mark up that rate, legally, then present you the higher rate as your approval, and keep the difference as profit. And the reason you don't notice? Because they don't sell you the rate, they sell you the payment. So instead of saying, we marked your APR up, they say, good news, we got you approved at $599 a month. And most people stop asking questions right there. This is why you need one simple line in your toolbox. Is this the buy rate? And then shut up and let them answer. If they dodge, if they get vague, if they say, this is the best we can do, you follow up with, can you show me the lender's approval terms? Because if you never ask, you'll never know. Now here's the easiest way to protect yourself. Walk in with a pre-approval from your bank or credit union. Not because you have to use it, but because it gives you leverage. It sets a baseline rate and it forces the dealership to compete on the real numbers instead of playing games with the payment. And then there's the part of the deal that quietly turns a normal loan into a money leak. The add-ons. This usually happens in the finance office after you think the deal is done. They start sliding in extras. Extended warranties, paint protection, tire and wheel coverage, theft packages, nitrogen tires, dealer fees, and gap. Now, to be fair, a couple of these can be useful in the right situation, but a lot of them are overpriced. And the real problem isn't even the product. The real problem is how they charge you for it. Because instead of paying for extras out of pocket, they often roll them into the loan. So your amount financed goes up. And that means you're not just buying add-ons. You're paying interest on them for years. Think about how wild that is. A $2,000 warranty doesn't just cost $2,000 anymore. If it's financed, it becomes $2,000 plus APR for 72 or 84 months. That's interest on top of interest. So when you see that itemized list, ask yourself, am I buying this or am I financing this? Because those are two totally different decisions. And here's the punchline you need to remember. You didn't just buy extras, you financed them. And once something gets financed, it stops being a small add-on and starts being a long-term drain on your monthly cash flow. Now let's connect all of this to the real danger that keeps people broke for years: going underwater. When you combine low or zero down payment with a long loan term, you can end up owing more than the car is worth, sometimes for a long time. Because remember what we just covered. Early on, most of your payment goes to interest, not the balance. And at the same time, the car is depreciating fast. So your loan balance stays high while the car's value drops. That gap is called being underwater. And this is where the income drain becomes a trap. Because if you're underwater, you can't just sell the car and walk away. You can't trade it in clean either. To get out, you either have to bring cash to the table or you roll that negative equity into your next loan. And that's how people end up with a new car and an even bigger payment. They're not just financing the next car, they're financing the last mistake. So the drain doesn't stop, it compounds. Once you're underwater, the loan controls your options. And the longer the term and the higher the APR, the easier it is to fall into that hole. All right, here's how you protect yourself from the payment trap in under a minute. Before you sign anything, you need 3 numbers, not 1. Number 1, APR, not around 7-ish. Not, it depends. The exact APR on the contract. Number 2, the term. How long are you in this loan? 48, 60, 72, 84 months? Because the term is what turns a manageable payment into a long-term drain. And number 3, the total cost. That means either total of payments or at least total interest. How much you'll pay over the entire life of the loan. Because the total cost is the truth. If they can't show you the total, that's not an accident. It's the business model. And here's the one power question that cuts through the whole game. Is this the buy rate, and can you show me the lender approval? Say it exactly like that. If the rate is marked up, that question puts pressure on it. If the deal has junk rolled in, that question forces clarity. And bonus tip, this one saves people thousands. If they won't show you APR, term, and total cost, or they keep circling back to, let's just talk about the payment. Walk. Because a deal that's truly good doesn't need to hide behind a monthly number. If you want, drop a comment with 3 things: the car price, your APR, and your loan term. And I'll tell you straight up if you're in a payment trap and what you should change first to stop the drain. And if this video helped, hit subscribe. Because I post verified breakdowns, real numbers, real tactics, not dealership math and payment games.